Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 248th VideoCast podcast for the week ending July 18th, 2024. A lot of great stuff to cover this week, so we're going to get right down to it. A couple quick pictures from this week. This is from the New York Stock Exchange with Remy Blair down at the FinTech TV booth. That was a fun segment we're going to get to in a minute. This was at the Boys and Girls Club of Harlem. That's Charles Payne right there. He also had his niece there who was shot literally 2 weeks ago, and he was talking about the importance of the club, and he's on the board and donates a lot. A lot of great local people we met, the people who run the incredible programs, and the vendors, of course, and then some folks that you all know from Fox. Kelly O'Grady and her husband were there. She's on pretty much every show as a correspondent. Lou Bassanese, you know, from Varney and Company and Cavuto. And then Jacob Sonnenschein, a writer for Barron's. And Will Leverick, he's a floor trader with TradeMoss. Charles gave a real heartfelt speech. He covered some of that segment on Making Money with Charles Payne today on Fox Business. This was another picture with Remy at the NYSE on Tuesday. This is in front of the NYSE. This never gets old, and it looked so amazing with the flags on Tuesday morning. All the American flags was just phenomenal. Got some golf in on Monday night. Not so great on the front, was 45, back was 41. I was coming in a little steep on the front. I fixed it on the back, just focused on the back left, inside left of the ball, and it straightened out my swing and dropped a couple putts, so that was good from the tips. And we're edging down. It's getting a little harder from 12.2 to 12.1 on the index. Hopefully we can keep the momentum going, but I didn't get much golf in this week, so that's that. You can see the teleprompters. It's kind of cool to see behind the scenes how they make the sausage. This is the CNBC booth. You can see Kramer there and David Faber, etc. All right, moving along. Want to cover this segment. First off, thanks to Jeremy Kasdan and Remy for having me on FinTech TV down at the NYSE. This segment really goes into our outlook in a very short period of time, so we're going to play it now.
Welcome back to Market Movers, the opening bell. U.S. stock futures are pointing to a lower open with the S&P 500 as well as NASDAQ futures off by 1%. Now Wall Street stocks rose and the Dow hit an all-time closing high in the previous session. All three major U.S. stock indexes advanced, but weaker mega cap growth stocks capped the gains for the NASDAQ. Meanwhile, the Russell 2000 has rallied nearly 10% in 5 sessions for its best 5-day performance since June 2020, but it is up over 12% year-to-date. Well, joining me this morning is Tom Hayes, Chairman and Managing Member of Great Hill Capital. Tom, so great to have you here today.
Great to be with you, Remy.
Well, we are seeing stock futures pointing to a lower open, but as you mentioned, it is no surprise given the recent gains. So what's happening right now?
Well, you know, I've spent the last two and a half weeks going around saying we're on the cusp of a sea change. We're on the cusp of a sea change. We're going to see this big rotation. Well, now we're in the sea change. And basically what you had in the first 6 months of the year is you had 5 stocks account for 60% of the gains in the S&P 500. And the back half is going to be flipped on its head. It's going to be the exact opposite. I think we're going to see the general indices more subdued because the Magnificent Seven are going to underperform, and the 493 are going to start to outperform in the last 6 months of the year. And we're seeing this. So this is volatility. This is people getting caught off sides, and I think we're going to see 2 key catalysts that drive that.
And speaking of catalysts, of course, we're all watching the Fed Reserve this year, and expectations for rate cuts heading into this year were very high, but now we're here in the middle of 2024 in the midst of a U.S. presidential election cycle, and we have yet to see a rate cut. So in terms of catalysts, what's on your radar?
Well, I think 2 things. Number one, we came into the year, everyone expected 7 rate cuts, and then it went down to like, we're never going to get a rate cut, and now we're back up to 95% probability of 1 cut in, actually 2 cuts by December, 98% chance of 1 cut by September. This is going to be a catalyst for that change, for the unmagnificent 493 outperforming in the last 6 months. That is a critical factor. The other thing to keep in mind, is June was the first month that 0 global central banks actually hiked. And that was the first time that happened since October of 2020, March of 2009, and December of 2001. And what happened during those periods? Those were generational periods to buy cyclicals, dividend payers, small caps, everything that was out of favor. So I like to say the last shall be first. And if you're overweight and fully concentrated in market cap weighted indices or Magnificent Seven only, I think you're going to be less happy than you were in the first half. And if you're in those unloved stocks from the first half, you've already seen it. Like many of us have seen the last 7 days like they've never seen before in their careers. It's mind-boggling. And I think that's going to continue, and we'll have the normal fits and starts that you're seeing right now.
And Tom, for those of the viewing audience who are trying to understand this market rotation and the implications of a potential rate cut on certain sectors, why do you think we're seeing small caps as an attractive option right now?
Well, the second catalyst, in addition to the Fed, is earnings composition. So there was a reason that the Magnificent Seven outperformed. For instance, in Q1 of this year, the Magnificent Seven earnings growth was 50%, 50. The Unmagnificent 493 was negative 1%. By Q4, that's going to change. The Magnificent Seven will have earnings growth decelerating to plus 17%. And the Unmagnificent Seven will be about 19%. So that's why you're seeing the stocks are following the earnings trajectory. As far as small caps, we're only having 4% earnings growth in 2024, but expected to be 17% for small cap earnings growth in 2025. And the markets are now getting ahead of that, both in terms of earnings composition and in terms of cost of capital, with the Fed lowering rates, cyclicals, dividend payers, small caps, and international will start to outperform as well as the dollar weakens.
And Tom, it is earnings season, so we're keeping a close eye on results as well as guidance for a better indicator of what we can expect. But are there any names that you're paying close attention to right now?
Yeah, there are two that are interesting to us that haven't taken off yet. You know, everyone talks about the ones that are already up 100%. We could talk about those, but that's not going to help your audience. So let's talk about some that are, we believe, just getting started. Intel is very important to us, and Intel is the most hated semiconductor stock. You can't give the stock away, and trading around $33, $34. There's two reasons to like Intel. Number one, their legacy PC and server business, the boring CPU business, that's worth $45 to $50 a share. The stock's trading at $33, $34. But you get a free option. The U.S. government has given them $45 billion of grants, subsidies, and loans to stand up a foundry to compete with Taiwan Semiconductor over the next few years. So it's effectively going to be a duopoly. They are projected to be the largest AI foundry by 2030 and the second largest overall foundry. So while NVIDIA, Broadcom, Avago, they fight a war and they try to kill each other, Intel's going to be the arms dealer. And that's where you can make your money, and most people aren't seeing that yet, and that will become more and more apparent. But in the meantime, you have a margin of safety because of their legacy PC and server business. They've done, they're going to exceed 40 million AI PC refresh this year alone, and they're a key beneficiary of that.
Okay, Tom, well, thank you so much for joining me on this Wednesday morning, and thank you for weighing in on what's moving the markets right now.
My pleasure. Thanks, Remy.
Thank you.
Yeah.
And we're back. Hey everyone, just a quick announcement here I forgot to put in. Next week from Wednesday through Sunday, I will be in San Francisco, California. I think Redwood City, to be exact. The girls have Junior Olympics tournament, so very excited for that. Any existing clients, new clients, or potential clients that would like to meet up for a coffee or a lunch, please respond soon so I can get you booked. Also, if you're a golfer and have a great track to play, make me an offer. I'll bring out my sticks and hope to meet some of you next week between Wednesday and Sunday. So that's good context. Also want to thank Faria Massoud for including me in her BBC article this week. You can see it there. And then some quotes of the week, a couple important quotes because we talked about when things shift, they shift all at once. And we're getting a taste of that. It's been a phenomenal week and a half for sure. And we'll get breathers and we'll get fits and starts, but I think we have begun what we've been waiting for some time in earnest, and it's not just hope because it's underpinned by the earnings composition, by the next moves of the Fed, and by everything we've talked about would be coming. But I want to read Seth Klarman says, typically we make money when we buy things. We count the profits later, but we know we have captured them when we buy the bargain. And that's kind of the theme, one of the key themes of what we cover here each week on Hedge Fund Tips with Tom Hayes. Robert Arnott says, in investing, what is comfortable is rarely profitable. We couldn't agree more. In the short term, when you're, to get outsized returns, you got to bet against consensus and you got to be right. And the way you're right for most of the time, if your analysis is and framework is correct, and you do it across a basket, the way you win is time arbitrage. And all the other people that are getting faked out by price or taking on too much leverage, they get banged out, and you have the luxury of time and without being on leverage, and the analysis is right, you've already captured the profits. It's just a question of when it shows up in your P&L. And as we've all seen, some of them show up in 6 months, some of them show up in 12 months, and some are a little more stubborn and take a couple of years. Benjamin Graham, but this is the final piece, but Benjamin Graham saying, those individuals who cannot master their emotions are ill-suited to profit from the investment process. Why? Because they think they have control over whether it's realized on the P&L in 6 months or 12 months or 18 months or 48 months, and you don't. All you have control over is the process. Are you capturing a profit relative to the underlying business when you purchase? Your win is when you purchase, not when you sell. Sell is just a question of the market recognizing that and the weighing machine kicking into gear. And over a basket of 8 or 10 done properly, while some will take, too long and take 48 to months or 60 months, some do it too fast in, 8 or 12 months. But on balance, if they're balancing out and you're getting your mean multi-bag in 36 plus months, you're going to have outperformance. And that's the name of the game. All right. A lot of great stuff. Another quote from Buffett. No, we don't try to pick bottoms, We don't have an opinion about where the stock market's going to go tomorrow or next week or next month. So to sit around and not do something that's sensible because you think there will be something even more attractive, that's just not our approach to it. Anytime we get a chance to do something that makes sense, we do it. And it makes sense, even if it makes more sense the next day. And if we've got money, we may do more. And if we don't, what can we do about it? So picking bottoms is basically not our game. Pricing is our game, and that's not so difficult. Picking bottoms, I think, is probably impossible, but when you start getting a lot for your money, you buy it. And as I say, after I wrote that, stocks did get cheaper. So this is the key line in what Buffett is saying. When you start getting a lot for your money, you buy it. That is the key. It's interesting. I was thinking about Generac the other day. And if you remember Generac, we were talking about in the 90s and in the 80s. And this is just one example, but this is what I was focused on. And if I could pull up a weekly here, just so you can see it. And it's kind of funny. So, we were talking about it in the 90s, and it dropped all the way down to 79. Before now, it's up to 156. I think it was 159 yesterday. So, it's up materially in a very short period of time. I mean, that's since last October, so it's not even a year. It's approaching a double. And I think a lot more gas in the tank. It looks like it's putting a reverse head and shoulders here, but leaving that aside. But if you bought at 90 and it goes down to 79, do you care? I mean, the key is we captured the interest in the business that is inflecting free cash flow, has huge amount of unlimited demand, 70% of the market, and is the Kleenex of home standby generators. And we were able to do that at a price with such a large margin of safety. Now, were we able to add a few more shares in the low 80s? Yeah, we were able to do that. But Are we upset that we didn't get the 79.86 tick instead of the 91.21 tick? We could absolutely care less because we're buying with such a margin of safety. We know we're getting a double out of it, probably sooner than we expected, and potentially a lot more. And we'll monitor the financials as we go through. But that's what Buffett is saying here is, it's almost as if, Klarman always talks about when we purchase, we expect it to go lower because you're so against consensus and you're buying it at such a price that doesn't represent the underlying fundamentals. The price is so out of whack at 90 or 80, or it could go to 50. It's kind of the same thing. It's so unrelated to the underlying business performance that, over time, it could go to 200, it could go to 250, it could go further. It's a rounding error where you're able to capture it, but you've captured it. And the only way you don't realize it and collect the money, as he talked about in the quote of the day, is if you're on leverage and you get stopped out or you get caught by some emotional thing or something that you couldn't know pops up, which is why you own more than one company. But so that's that. So we're going to go through a ton of data today. China's final run to 2030. This is the best chart. This came from the Wall Street Journal, talking about what we've been talking about and how when you have the largest percentage of your population, your low to mid 30s, you get these parabolic moves for 6 to 8 years. And China is best suited. America's even better suited as it relates to this. Japan is toast. Or certainly we've seen the results of what happened when Japan hit 40 in 1990 and how they lost 3 decades. I think China will lose 3 decades after one final parabolic move. This is really interesting. This is motor vehicle assemblies. This is from the Federal Reserve Board and Haver Analytics. As you can see, motor vehicle assemblies are actually going up higher than 2015. So we are starting to hum, and it's just a different way to skin the cat. I know auto SAR was a little lighter in June, but when you look at assemblies, it's all leading to everything we talked about in our initial thesis in Cooper Standard in May of 2022 when we initiated in the $5 range. Rich valuations and rising overseas interest payments will hurt the US dollar in the long run. So you can see it here. Again, going back to this looks exactly like what we saw in 2001. And we've I can't emphasize this for the last 4 weeks. We've been showing you all the similarities and what took off and outperformed through 2007, small caps, cyclicals, emerging markets, dividend payers, China, etc. And this weak dollar, it says here the dollar is 21% overvalued on a purchasing power parity basis. So that's there. And then you've got core CPI month on month. We know about that. Rent of primary residence is starting to come down materially, as you can see here, lowest since it's going, it's at 2021 levels and it's all the way back below pre-pandemic levels. So that will show up in owner's equivalent rent, starting to drop off big. So anyway, everyone knows that now. It looks like a 98% probability, according to the Fed Funds Future, of the first cut in September and second cut in December. So that's that. They're now pricing in 2.4 cuts. I think this is up to 2.7. I literally think if they start by September, they could potentially be 2 and done. I know they're expecting to do more based on the dot plot, but they may not have to. We'll see. Data is slowing, but just the expectation of the cuts will start to ease financial conditions a little bit, and we'll see how it goes. Sector returns in the last 4 weeks. Technology was the worst. Real estate, utilities, and transports were the best. Shocking. You got to read tomorrow's newspaper today about 6 weeks ago when we were talking. What was the worst here in the last... this is recent this week. Same thing. You're seeing growth and momentum fall off. Small caps, mid caps, dividend aristocrats, equal weighted all outperforming of late. equal weighted index to the S&P 500 is starting to dramatically outperform all the things that we've been pointing to. Guess what happened here? The yen fell bigly this week. I think that's just the beginning relative to the US dollar. So the dollar is now weakening against the yen, which is we've been waiting for and talking about and saying they would have to intervene. And here you go. Russell 2000 versus large cap tech is starting to inflect in a material way, relative daily changes. So anyway, it was 4 standard deviations move in small caps, and like it's never happened before, how quickly. And that's what I've continued to say. The more this rubber band got stretched, the more abrupt the turnaround. And what you saw in the last week and a half was abrupt. And, we we had a week and a half of smiling so wide we could eat a banana sideways. So it'll be fits and starts, but the trend is there. It's not going to be a fake out as everyone's guessing, because the earnings are supportive and the Fed's next moves are supportive, and conditions are supportive. Moving on, going back again to 2001. Lowest ever 3-month correlation between S&P and advancers drops below 2000 nadir. This is an interesting chart here. What this talks about, Sequoia did an article basically questioning the valuation of NVIDIA after we put out our next pain trade article on June 20th, which was the top of NVIDIA, by the way, and we put it out at 7 a.m. before the opening. We wrote it the night before, as we always do. So what they're basically saying is that if you look at NVIDIA data center run rate revenue, so it's grown, from 50 billion to 150 billion. Data center facility build and cost to operate is 50% of that. Implied data AI spend is 300 billion for the industry. Software margin is, so they make 50%. So the implication is that their customers have to generate $600 billion of revenues to make it make sense the amount of money they're spending on NVIDIA chips. And so the subject of the article that Sequoia wrote was the $600 billion question, meaning there's no way that they're going to be able to generate the revenue required to justify the spend. And what they're effectively saying is there was a huge pull forward for NVIDIA, a scarcity arms race to hoard as many chips as humanly possible from your competition, even if you don't know what you're going to do with it. But after you've hoarded all the chips you can get, and your competitors have hoarded all the chips you can get, and you can't generate the revenue, and you got to explain to your board why you spent all this money that is not leading to revenue and profits, the spending stops. And I think the market's starting to sniff that out. This is the index of aggregate weekly payrolls. The biggest gains were in construction, financial, manufacturing, which we've talked about, the manufacturing recovery, and the lowest were in IT and retail. Manufacturing orders were interesting. New orders, you had growth in computers and related products that helps Intel, and growth in motor vehicles and parts, which helps Cooper Standard, transportation equipment, etc. And then retail sales, motor vehicle and part dealers was up. Economic surprise index in the UK up. This recovery is happening. How are we playing it? Through GXO and a smaller tiny position in ASOS, which we haven't leaned into yet. Leading economic indicators and real GDP starting to turn up, which is positive here. And you see this out of big troughs, and everyone gets nervous with the leading economic indicators turning down, but it happens every recovery. Even at 2020, you see real GDP, it troughs, then it spikes higher, then it normalizes, and then it, for multi-years, continues to grow. That was 2009. Then you see it again in 2020. You saw it in 2000. You saw it in 1980, the last time we had this aggressive of a hiking cycle. You have your first down in 80. second down in 82, and then the recovery and many years of prosperity thereafter. This is a bunch of leading economic indicators you can see mostly pointing in the right direction, whether it's consumer expectations. Building permits was turning down. I think we had a good number this week. Consumer goods orders, interest rate spread, leading credit indices, new orders by major industries. This is primary metals. These are all turning up. Electronic equipment, motor vehicles and parts is looking like all-time highs here, by the way. Pretty exciting that thesis is playing out. Machinery, that's the manufacturing story. Electronic products, etc. Here we have this is very interesting. This makes the case for the growth of $1,000 since 1950 if you had invested exclusively in U.S. equities, or you did global equities out excluding the U.S. And the net effect is, with world equities, you outperformed U.S. equities by a pretty wide margin. And people are getting suckered by recency bias of the last 10 years, where U.S. has been the only game in town. And that historically has not been the case, which is why you want to start to pivot when everyone's crowded to one side of the boat. Corporate America's profit outlook continues to improve. Quarterly earnings growth year on year and estimates year on year. S&P 493 to post profit growth for the first time in 6 quarters. That's why we're seeing the rotation. This is another chart. 80% of global central banks are expected to be in easing mode by the end of 2024 versus only 10% in July of 2023. This looks exactly like what we saw in 2000 by the end of 2009. Early 2009 to the end of 2009 recovery. Same thing with what? 2001. Can I hear it again? 2001. Okay. And here we go. You start to see the easing cycle start and you get multi-year recoveries. Easing cycle start, multi-year recoveries. This is a chart from Fundstrat. Tom Lee over there talking about what we've been talking about for the last 2+ years, actually since 2020. When we were saying we're generally constructive through 2030 because of the average age of millennials here in the US, it's about 31, 32, and it shows their spending cycle and what they spend money on. So, in their 20s, and then as they get older, and their spending goes to its peak by the time they're 37 to 40, and then it levels off at the highest levels. Right now, it's just in that ramp up phase where they're starting to get into houses. As rates come down, we'll see more and more getting into houses. As more supply comes on, more will get into houses. And then in China, it's like a year ahead for their echo boom, and you get that huge parabolic move, and that's the empirical data that supports it. Core PPI, we saw this was weak. Interest rate differentials are the main cause of the yen's undervaluation. That's going to be changing because their inflation is ticking up, so they're going to continue to be restrictive, and we saw it in the currency move finally in the last week or so, as we've been expected for multiple weeks. Household C prices shooting up. This is the Bank of Japan survey, shows inflation expectations at record high, which means what? It means that they are going to be tightening, which means what? Yen stronger, dollar weaker, money moving out of Japanese equities, hot money, into Chinese where they can find value. Same thing with India. CPI month on month, new vehicle prices are coming down. And I think we covered in recent weeks how, like, most people think inventories building and prices coming down is bad for the Cooper Standard story. It's great for the Cooper Standard story. The exact same thing happened from 2015 to 2017. And then it starts to become a race to the bottom. We talk about Intel being the arms dealer as NVIDIA and Broadcom and Advanced Micro Devices, let them all kill each other. Intel will be the arms dealer, foundry, like Taiwan Semiconductor is, and they'll make all the money. It's the same thing with cars. We want them to have over inventories and start incentivizing and getting more and more, getting the affordability down for cars, which is starting to come down, by the way. I think we have got a chart at the end I'm going to show you from Car Dealer Guy, is showing that like the amount of weeks worked to afford a new car has come in by like 3 weeks. I think it went from like 43 to 37 or something like that, up from 33, but it's moving in the right direction. And then when you get, and it's just like generators. When your neighbor gets a new car, you get a new car, and then the whole society starts to get new cars. And that's what we saw in 2015 to 2017. So yes, you want to see prices come down. You want to start to see inventories at the lots going up. So they have to offer incentives to make it more affordable. The more people that get new cars, the more people are going to want a new car. Just like in Generac, the most highly penetrated regions like Texas and Michigan that have 7% penetration relative to the rest of the country that have 3% penetration, you would say, oh, they're saturated. No, they have the highest growth rates of 20+% year on year, because you never want to be the only person on your block with candles when you hear all their generators humming and they're watching movies while you're, baking with no air conditioning. So that's positive news. Faster wage growth lends support to a BOJ hike in July. So this inflation is starting to move in Japan, which means they're going to be hiking, which means dollar weaker, which supports our China thesis. Consolidated equity positioning, highest since November 2021. So this is some warning, but you also had a similar situation in 2018. So it's not the all end all, and it can stay more extended. I think the market cap weighted indices, as I shared with Remy, are going to be, that are concentrated in Mag 7 are going to be more subdued. And so you could see what looks like a massive correction and enough action under the surface starting to go up. And we've seen a taste of what that's going to look like in the last week, where the NASDAQ was getting shellacked and small caps were ripping through the roof and cyclicals and everything else. It was pretty exciting. Some days there were like 400 stocks up and the general indices were down. It was awesome. I was like, this is literally like Christmas in July. Small caps breaking out. We'll cover that. Maturity wall for first lien loans. So everyone's, keeps talking about this debt wall coming up and all these companies are going to go bankrupt. That doesn't kick in till 2028. And if you look at the Fed's dot plot, rates are going to be a lot lower by then. We're not even into 2025. So that doesn't become a factor till 2028. And my guess is by mid next year, all these companies are going to hit the window and get this pushed out to 2030 and beyond. And that's probably when we'll start to worry, in the early 2030s. Q2, first EPS growth quarter for the other 493. I want to keep emphasizing this fact that we're not just praying for a rotation. It's based on empirical data. The earnings support it and the Fed moves support it. Russell 2000, S&P 500, you can see it starting to take off again. 4-day rolling returns were unbelievable. Now the fund flows are coming into IWM, which is the small cap ETF. You can see it was just coming off the mat. Now it's moving up parabolically the last few weeks. Real federal funds rate has never been higher, probably since the early 80s. So that's why I say it's extremely restrictive. It's 240 basis points above neutral. That's super restrictive. So the implication would be 6 cuts. But I think if they do 6 cuts, they got it too late. I mean, I could really see a scenario where they do 2 and done, but they'll probably have to go 4. They'll probably overshoot on that. And 4 would bring it back down to still restrictive, but I think there'll be enough growth that that's okay. Fed staff monetary policy, clear case for cuts. Okay, we know that. Average treasury yield moves after first rate cut. Remember, our overriding thesis was yields down on the 10-year and dollar down. Okay, we're seeing the dollar and yields both move down, and after the first cut, that continues. So we've started to see this first move down before the cut. That's going to persist, and it goes a year out. They anticipate about a year out, you're looking at almost 75 basis points to 100 basis points lower than today. So I think today, call it 419 if I'm not mistaken. Maybe it was lower today, maybe 420. So figure 325. I mean, and remember at 475 just a few weeks ago when the world, everyone thought it was going the other way. I said, look, everyone's calling for 5 again. I'm telling you, it's going to 375 before it goes to 5. And maybe it's going to 325 if we look a year out based on this empirical data. Okay, outside of COVID era, growth trades at historic trades versus value. That's going to unwind. Small size factor is historically cheap versus large size factor. That's unwinding. Dividend yield is neglected by active managers. That's going to unwind. Dividend yield remains inexpensive versus history. Not this cheap since 2000 and when? 2001. Okay. Growth versus value expensive on a book value. You want to buy growth here? Have at it. Growth versus value expensive on trailing EPS. Growth versus value elevated on price to sales. Growth versus value elevated on PE to growth. You can say this time is different, but I would argue that it's never different. There's a saying that good things happen when you buy assets at low valuations. And I would say the opposite is true. Bad things tend to happen over time when you buy overpriced assets. And that's what's happening for everyone crowding into the most crowded trade. What they're going to wind up with is an empty bag for the most part. Now, forward EPS yield remains under-owned by fund managers. That's dividend. Low price to book is under-owned by managers, which implies financials to some degree, energy, cyclicals. High forward EPS yield trades below historical average. Yield is just the inverse of the PE ratio, so means low PEs. Low price to book trades below the historical average. So there's a lot of places. We talked about where there's outperformance after the first cut. Mid-cap ETFs recent buying after selling spate, so they're starting to get back into mids, which is good to see. The other 493 expected to come out of earnings recession in Q2. So why haven't they been performing? Because they've been in an earnings recession. So price will follow earnings, and now we're seeing that inflection, and we're going to see it. So far, earnings are up 9.3, so they are exceeding expectations, but not a lot of companies have reported yet, so we'll see how that plays out. And where are you going to see the biggest earnings growth in Q3? Communication services, everything's going to be positive. Energy still going to be negative, but you see consumer discretionary positive. You see staples, financials, healthcare. Pretty much every sector is now positive, whereas last quarter, industrials were negative 2%. This quarter, they're going to be 11%. So that's huge. That's companies like Stanley Black & Decker, Generac, Boeing to a lesser extent. Materials was negative 9% last quarter. This quarter it's going to be plus 9%. Real estate was negative 2%. This quarter is going to be plus 4%. And it goes up even more in Q4, and the market is sniffing this out. Again, that is the key theme that I've been trying to hammer home, and that's why we're seeing the amazing things we're seeing in the last couple of weeks is because of that. And even if you'll have the fits and starts, that trend is real, and that's going to persist in the second half in our view. Even if it's held down a little bit before the election, once that resolution is there, although the market is trading like the election's already decided. If you've been around for a while, you take nothing for granted, and you just focus on fundamentals and let the politics work itself out. Okay, this is key. Tech's outperformance has been highly correlated to its earnings versus the S&P since the tech bubble. Narrowing growth differentials should lead to the market broadening out. So again, this is not, it's like we always talk about looking under the hood. It's not they have to come in because they're overvalued. It's they have to come in because their earnings growth, the Magnificent Seven, is decelerating relative to the unmagnificent 493, re-accelerating, and therefore their respective groups will price perform in accordance with the underlying business inflection. And that's what we do on a micro level. This is talking about it on a macro level. Korean exports remain strong. Rail freight car loads remain strong. And our favorite chart, the destock restock cycle, almost back up to the flat line here. Wait till we get into expansion. We haven't seen it like this since the big run in 2000, but the bigger run in 2009, 2010, which led to a multi-year cycle. And then again, back to the early 2000s, 2001, 2002, when we got that huge cycle. Also, new orders to inventory ratio jumped in June, reversing the year-to-date downward trend. This is a big deal. This deals with the destock restock cycle, which is a theme in our portfolio, which is now playing out bigly. BOA, private clients and T-bills, no one in treasury bonds. We've been talking about the rally in 10 years. No one believed it. It's happening, and it's going to persist. And if it passes any prologue a year from now, that yield on the 10-year could be, well into the threes, which means a meaningful rally for the TLT, etc. Even though we've already had a meaningful rally, which we talked to you about over a year ago, and it's played out in accordance with expectations. Bull bear indicator stretch, but not at extreme yet. Gold is discounting a collapse in real rates. We agree. Okay. So this is the inverted 10-year real rate inverted. You can see it normally correlates with gold. Gold is going up, and it usually correlates 1-to-1. So this will be a catch up. Regional banks, lowest versus large banks since October of 2009. Generational opportunity. The KRE is starting to rip. Large cap growth at the highest versus small cap value since 2000. You know which side of the trade we're taking on that. And this is going to be a monster home run. I mean, COVID has created, it's been such an exciting blessing, certainly to see. Obviously, in the last week with all the new people coming in, super excited, grateful to have you on board. And in the last 2 years, the idea that you could get involved in the last few years with all of the opportunities, once in a generation opportunities that COVID has created that haven't even begun to start playing out and are going to be realized over the next 3 to 5 years, like insane. This stuff, look, it happens every 25 years. Just look at the charts, ladies and gentlemen. We've got to go back all the way to 2009 and 2001 to get conditions like this where you can make generational opportunity returns based on these type of dislocation. In a normal environment, every normal year, you have to dig through the rubble and you find some good opportunities here and there. This, it's like fishing with a shotgun. It's unbelievable. And it's going, so don't miss the train, but it's going to be many years of unbelievable recoveries for these great businesses that we're so lucky to buy. And we've already, like Klarman said, we've already made the money. We know, when I talk about, I think I talked about 2 years ago, all I think about every day when I wake up is how am I going to make my clients in aggregate 30 to 40 million of profits this year. And now we're starting to humding towards that in the last 2 weeks. When they turn all at once. Now we're just waiting for China to click in, and then it'll just be hockey stick. And but that's only one position. We know we've already made the profits when we buy them at levels that they only serve up once every 25 years. These opportunities don't come every year. Okay, so I'm just trying to illustrate. I'm a visual person, and that's why I'm showing you guys so many guys and girls, so many charts, because this doesn't exist. Here's GXO Logistics got upgraded this week by UBS to $71 price target. They'll take it up to 100 after it hits 71. That's why opinion follows trend. Retail sales heat map, we covered this. That was June, and what did I want to cover here? Auto parts were up. Okay, so that's good. And global IPO activity, this falls in line with our Citibank and Bank of America stock holdings, and like, we've said we expect them to take a break because they've moved up so much so quickly. But why aren't we trimming? Because the global IPO activity hasn't even started yet. Okay, we're in a depression for M&A and capital markets. So, when we get back up to, I'm not saying we're going to get back to 2021 levels, but when we get to, 60, 70% and they're up a bit more, then we'll consider trimming back. But like, the prices move so much and the game hasn't even begun yet. And that's why I say, like, these opportunities are so amazingly rare. Valuation advantage for private equity is long gone. Those of you chasing private equity at these levels, good luck with that. They just trade these businesses back and forth to each other and charge 2% fees to each other. It's disgusting in my view, but whatever. Private equity funds are having companies issue more debt to fund investor payouts. There you go. This will also, by the way, support more IPOs because they'll dump them on the market once the market is ripe. As they say, when the ducks are quacking, feed them. We're nowhere near that. But Citi and Bank of America will be major beneficiaries of that. After the first Fed cut, value led growth for 6 months. Small cap led large, 3, 6, 12 month, and bonds led stocks. So this is all in line with what we've been saying. This is the dollar DXY average trend since 1970. It tends to decline in July, rally a little bit in August, and trend down all the way through the end of the year. So weaker dollar supports long China, the back half. Average trend so that's since 1970. And you can see here, this is the US dollar chart, weekly chart. And the implication is a move to the lower end of the range, which would be around 100, according to this. I don't give a terrible amount of credence to this, but I can see the long range trend, and that would be in line. Global equity dry powder is at record high, so this is very positive from the standpoint you saw Starboard get into match this week. Okay, we talked about that one and Ask Me Anything questions. Love the free cash flow. Revenues were flat, but it was a cash machine. What was the catalyst? Well, you're going to see more of these catalysts of private equity coming in for public companies because some of them are trading abnormally low relative to their intrinsic value. Here's the SAR. This is the seasonally adjusted auto data from Ward's Auto Infobank via Bank of America. The reason you had a 3% decline in auto SAR in sell-through in June was because of that CDK software problem. If you remember, they had no software to sell cars for like 2 or 3 weeks, and that impacted the numbers. So I think that's just pent-up demand, and I don't think that affects production, which is where Cooper Standard gets paid, which is why we want to see inventories grow, prices go down, incentives increase, so more people buy cars because we want them producing as many cars. We don't really care how much money Ford and GM makes on a car. We let them kill each other with the Japanese makers and the Korean makers. Let them all have a price war to the bottom. Yeah, at the margins it affects us because if they get squeezed, they're going to squeeze the suppliers over time. But if they're doing big volumes, Cooper Standard is just crushing it, like 2015 to 2017, which was low margin, high volume. And everyone says we're never going back to that until your competition floods the market with those cars that you were unwilling to sell because you only wanted to sell the high margin cars, which we talked about 2 years ago when we were getting involved in the position, and all of it's playing out exactly as expected. June inventory increases 92,000 units month on month. Supply came in above the 5-year average. This is big news. You want to see this type of stuff like we saw in 2007. No signs of slowdown in auto sales, so they're moving in the right direction. You saw that June, that was because of the software. And we got, this is from Ward's Automotive Sales. This is your sell-through. And you can see we're making progress, but we got to get back up to this 17, 18 million, and we're below 16. And this little extra bit, it's kind of the difference between gold medal silver medal, bronze medal, never heard of. And it's like 1/10 of a 1 second for those 4 different positions, depending what sport you're in. It's mind-boggling. It's literally like, ding, and then and it's the same exact thing with Cooper Standard. It's like below 15, you're barely cash flow positive. You're grinding along, cutting costs, hanging in there, paying your bills, and then you go to 16, and this cash starts to gush out the bottom end. And then 17, you're making so much money you don't know what to do with yourself. And then 18, you got $146 stock. So, it just takes time. I wish this went back further to 2009. I'll have to get the data, but I'm sure the ramp up was very similar. If you remember cash for clunkers and all that stuff when the volumes were low. This shows price to earnings of Magnificent 7 plus Netflix. This is from Wisdom Tree. And you can see forward PEs on NVIDIA 47 times, Microsoft 36, Apple 17, and you compare it with their long-term growth rate and their estimated long-term growth rate and their trailing growth rate, and you can get a sense of price to earnings growth and see the difference in multiples. And then that's the Magnificent 7 plus Netflix. It trades at an average of 36 times earnings, whereas the S&P 500 X the Mag 7 and Netflix trades at about half that multiple, and that's where we're finding all of the value. This is S&P equal weight to S&P 500. Again, you have to go all the way back to the early 2000s and 2009 and 2000 to find these opportunities. 2000 was one of our best years in history. And then you go back 2009 and 2000 to find these same opportunities. And here we are once again and taking full advantage of it, bigger, better, and more excited than ever. Short interest as a percentage of market cap is nearing 2-year highs. So there's a lot of short interest, which is why you're seeing these abrupt moves. If you remember the sector relative performance that we covered last, 3 weeks ago when we were on Charles Payne, they're now turning up. If you look at all these sectors, remember they were just going to the oblivion, and now they're all turning up. Consumer discretionary, financials, relative performance to the S&P 500. But what's turning down? Only one. It's called infotech and communication services. The ones that were outperforming are now rolling over. Everything else is turning up. Utilities, real estate, materials, energy, financials, healthcare, Staples didn't turn up yet. But I think they just broke out to new highs, so they should be turning up. Industrials and consumer discretionary all turning up. Blasted buying small caps could have bulls smiling. This is from Carson, Ryan Dietrich, 12 months later, median return 25% more. That's in line, so they've rallied some 10, 11% in the last week. Tom Lee is calling for another 40% before the end of the year. If small caps are up another 40%, I mean, it's going to make the last most exciting 2 weeks look like a drop in the bucket, which would be super exciting. And this data also supports that. Stocks above their 200-day moving average, it went from end of the world to back on track. Russell 2000 gained 55% after the Fed stopped raising rates in 1995. That's a big deal. And I think that's how FundStrat is probably reverse engineering that call for 50% up in small caps this quarter. But it's just a normal cyclical call, and we're well on our way now, starting to make the move. And you can see what happened last time as well. This was the bottom. Now we're coming into cuts, and then the fun begins for the next 2 years, basically, in small caps. And again, what happened? 2000. Can I hear it? 2001, baby. Price to free cash flow is, actually reasonable. Okay. So, 26 versus got up to 50 and 95 to 2000, depends on the company. Percent of Wall Street analysts with buy recommendations on NVIDIA. As of 2 weeks ago, when we put out the next pain trade, it was 100% of analysts were bullish on NVIDIA. Now it's down 20%. Let's see what happens. As you can see, biotech is finally breaking out of this 2-year range. And onto the longer the base, the higher the space. We're going back to new highs here. Small caps doing the same thing. Longer the base, 2.5-year range now breaking out. We're rocking and rolling. Fed's new financial conditions index. This is from the Fed and Billionaires Portfolio. This is pretty exciting because you can see each time that this got elevated and started to roll over, i.e. when this number is above 0%, it's a drag on GDP growth. When it falls below, it is a propellant. And you can see it peaked in February of 2009, which was the low in the markets. It peaked in January 1995, which was that mid-cycle thing, which we've compared a lot. And it peaked in 2001 and 2002. And as it rolled over, you had multi-year rallies. I can't emphasize this story enough, ladies and gentlemen. And as big as we've had the rally since we've been pounding the table on bonds since October 2023, as a matter of fact, we were pounding it from August, and it took another couple of months to October, and then it took off. It's just now doing this golden cross and just starting to break out, and it's got a lot more upside. So lower rates are coming to a theater near you. China's youth jobless rate dips in June. I don't know. This one, it's interesting. Everyone says that China lies about their numbers, except when their numbers are terrible. Then you never hear that they're lying about their numbers, except from the perma bears who say, well, if their numbers are this bad that they're reporting, imagine how bad they must really be. You get a few of those guys, but they never tend to have much money. So it says here, China's youth jobless dips in June. So basically from over 20%, and then they stopped reporting for a few months. Now they're reporting again, and now it's down to like 12%. I actually wouldn't be shocked by this, and I think that people, they've been doing this stimulus in drips and drabs, and I think the compounded lagged effect is starting to kick in, and it's going to catch people by storm all at once because it's building underneath the surface. And so that's a data point there. S&P returns when there is a whaley breath thrust, which we just had. 252 days out, like a year calendar, mean return is 24%. This is the seasonality that we discussed in the article of the week, which shows during an election year, you tend to get this rally in July, and then you get a little hiccup late July. So maybe we're seeing some of that. So in the next week and a half, if the indices are down a lot, don't worry about it. Probably get some strength before the fall, and then we'll worry about a little bit of volatility before the election and before the final year-end rally. Profits recovery for small caps is very back-end loaded. So we're going to see the biggest, we inflect next quarter bigly, and then Q4, Q1, Q2, Q3, Q4 next year, we start to have greater earnings growth of small cap than large cap, which is part of the reason they're going to rip and start to discount that. CEOs are more bullish on the outlook. Again, big dip, and then a recovery like when? 2001, 2009. I mean, this is just such an exciting time to be in the business. Jobless claims were super high. That's good for the Fed, gives them cover. Same with continuing claims today. Earnings expectations for AI stocks are falling, okay? So everyone crowded into the same boat. Those earnings estimates are falling while the rest are going up. And this is what I was talking about from the car dealership guy today. It takes 37 median weeks of income to purchase a new car. In 2019, that number was only 32 weeks, a 15% increase in under 5 years. But there is a silver lining. 1.5 years ago, the number was closer to 43 weeks. So we're down to 37 weeks from 43 weeks, which is up from 32. So we're headed in the right direction, and that's going to get more people out to dealers. So now they're pricing in 2.7 cuts. I don't know. I guess they're thinking September, November, December for this year. Manufacturing's coming back. You saw from the Empire manufacturing orders. Credit card write-offs are on the rise, but at historic lows and actually leveling off. Wage growth expectations have declined significantly. That's good for the Fed. 30-year mortgage rates have come off pretty big in the last few weeks. So they're down from 7.5% to 6.75 for 30-year fixed. That's going to get some more activity coming back in, some more supply back on the market, which helps OE owners equivalent rent. Manufacturing again ticking up. U.S. industrial output posts largest back-to-back gains since 2021. What did I say? We've been in a 2-year manufacturing recession. We're coming out as part of the destock restock cycle. Everything's out playing according to plan. Beige Book Index dropped, but is far from recessionary territory. This is what it always happens. They shoot up out of these things, and then they check back, and then they go sideways while the market rallies for multiple years. Distribution of interest rates on outstanding mortgages. Very few are above 6%. You can see the bulk of them are here between 3 and 4%. So the consumer debt service is still at historic lows. GDP to USD. British pound has been rising materially against the US dollar, which we had called for, which is going to help who? GXO Logistics, which gets 50% of its revenues from UK. EU passenger car registrations are accelerating. Good for Cooper Standard. You can see here. You see the US dollar to Japanese yen rolled over finally. Dollar weakening, yen strengthening. Japan keeps up yen warnings. $6 trillion yen 2-day intervention suspected. That's from Reuters. Japanese yen surges as carry trade loses its attractiveness, says SocGen. Fund manager survey, investors are overweight utilities for the first time since February of 2009. Ladies and gentlemen, you remember me pounding the table on utilities for a year. Well, here we are. And so you probably time to lay off a few of them. I'll have to look at them, but probably have a little bit more juice, but interesting. Relative to U.S. history, overweight utilities, bonds, U.S. and underweight REITs, cash and industrials. So they're overweight that. They're underweight REITs. So REITs probably start to move, especially in anticipation of rates. CTA position is near the max level exposure, highest since 2021, which bodes for an indice shellacking, which is predominantly the Mag 7, while you could have the indices weak while the rest of the stocks perform to hurt the CTAs and hurt the people that are in the most crowded trade and help the people that went against the grain, small caps, cyclicals, dividend payers, international, etc. States with the highest rates of Olympic gold medal wins. Maryland, that's because of Phelps, by the way, followed by California, which is why my daughters are moving to California for 4 months in the fall. So I'll be back and forth. That one is going to a development program for water polo that she got accepted into. And the other one will swim with one of the best teams in California while they're there. So kudos to them. Very proud of all the hard work. So we make things happen for them to help them get to their goals. Here's a saying from dividend growth investor Warren Buffett is famous for saying, after we buy a stock, consequently, we would not be disturbed if markets closed for a year or two. We don't need a daily quote on our 100% position in C's to validate our well-being. Why then should we need a quote on our 7% interest in Coca-Cola? Sometimes Mr. Market offers a tremendous bargain, and sometimes Mr. Market offers a ridiculously high price for an asset. Most of the time, it pays to just ignore Mr. Market unless you want to take advantage of this moody fellow. People focus too much on stock price fluctuations, end up being influenced by manic depressive Mr. Market. They feel the urge to do something, which leads to many investors selling low and buying high. Most of these investors would likely do better by sticking to private businesses and real estate where they do not get a daily quote. Okay, now this is a big thing, and I've covered it. Why I don't do privates. While most people would be better off being in illiquid private businesses in real estate because they don't get a daily quote and they won't be forced to sell at the wrong price. They also don't get aberrationally depressed prices because no one in their right mind would sell assets at prices sometimes quoted in the public markets. And that's why we love public markets, because the price swings can be so egregious relative to underlying value. And that's where the dislocation and opportunity comes from. This lets them focus on the business, its fundamentals, and ignore all the noise. For many folks, the instant liquidity that a stock market offers is more of a curse than a blessing. Perhaps these folks would do better off buying and owning private business, but if they were to invest in equities, They need to see themselves as partial owners of the business enterprise and not view stocks as some sort of lottery ticket. Perhaps that's why Warren Buffett has stated you should not buy a business unless you're willing to hold it for a decade, even if they close the stock market for 10 years. Thinking like a business owner has a lot of advantages. Mostly it lets you focus on the business and ignore the noise. Second, it helps you stay patient when everyone around you is panicking. This was evident during the global financial crisis, was evident during COVID-19 crash in 2020. A few investors can sit patiently when their stocks are going down or even going up. So there you go. Here we go. Alibaba repurchases on a roll. 3 months ended June 30th. Record repurchases. Looks like just under $6 billion of repurchases. 5.8 billion, which was huge. Third, Plenum communique released. So this is from Brendan Ahern from Crane Shares, the KWeb ETF, $6 billion of assets. What he said, third Plenum overview, quote, communique of the third plenary session of the 20th Central Committee on the Communist Party of China was released after the market closed. Expectations for major policy reform to be announced were low, as the 4-day, every 5-year third plenum is a high-level meeting discussing the big picture, as the task of implementing falls on underlying departments. The plenum provides an insight into the government's understanding of the economic situation. The current Hong Kong rally has slipped since mid-May due to lackluster economic data. In our recent piece, several positive catalysts are on the horizon specific to the internet space. Parentheses, August Q2 earnings, buybacks, southbound stock connect inflows, i.e. Alibaba, by the way. Remember, their dual primary listing should go into effect in August or September and bring all the 180 million potential new investors from mainland through Stock Connect. However, recent tepid economic activity, last Friday's credit data, Monday's June data, and yesterday's youth unemployment number only reinforces the necessity of monetary policy support. Do the 199 members of the Central Committee understand the economic situation? The communique is a universal yes. In the first real paragraph, the communique states, quote, it is agreed that in the face of severe and complex international environment and arduous domestic reform, end quote, what are they doing about it? Below are a few highlights. Quote, the Central Committee made systemic plans for further deepening reform comprehensively. Quote, guide the development of the non-public sector. Quote, high quality development is our primary task. Quote, pursue coordinated reforms on the fiscal, tax, financial, and other major sectors. Quote, actively expand domestic consumption. Let me repeat that one. Quote, actively expand domestic consumption. So that's their focus. Quote, implement various measures to prevent and resolve risks in key areas such as real estate, local government debt. Well, these are the two things that you need for Alibaba to work. Fix the real estate problem, because 70% of the wealth is in real estate, and actively expand domestic consumption. Moving on, he says, we had the usual, quote, opening up comments as anticipated. I'm unsure how US-China ADRs will react, though I suspect Asian investors will view the release as positive. Tomorrow there will be a press conference with further details provided. So there we go. Next article, Xi Jinping's quest for high quality growth is starting to pay off. That's not the one I wanted to see. China tries to hit more birds with one stone in property rescue push. So they're doing this. Now, this one is very interesting. Xi Jinping's great economic rewiring is cushioning China's slowdown. And what they're talking about is the twin track economy is generating doom and gloom headlines about domestic woes one moment and growing fears around the world about dominance of its manufacturers the next. So what they're basically saying here is they've shifted focus away from real estate and to tech. So over the next few years, what you've been seeing is property's contribution to China's GDP, whereas, 6 years ago, it was 24%. Now it's only 16%. And what has picked up the slack? Well, the area that we're invested in and focused on, which is high tech, has gone from only 11% to now 18%. So that is a big deal. And then EV, battery, and solar has gone from basically 0 to 4%. But that's not the area we're focusing on. So this is a rebalancing, and that's why there's a lot of friction and choppiness. But it's moving in the direction of what we want to be doing, and that's that. And I think in terms of what Buffett was saying about shutting down the market for 2 years or whatever, if there had been no quite price quotes on Alibaba for the last year and a half, 2 years, and you looked at the financials today, or actually the last 10 years, and you looked at the financials today and 2 years ago and 6 years ago and 10 years ago, you would be super excited by the fact that the amount of revenues per share that you were getting, the amount of earnings per share that you were getting, or per your ownership interest you were getting, and the amount of free cash flow you were getting had dramatically improved, and therefore the value of your investment had dramatically improved. And now we just wait for the market to, just as it's irrationally priced it in the short term, it will exuberantly price it in the intermediate term. And you'll know at some point when the market is paying entirely too much for the beautiful free cash flow that it generates, and you'll be able to feed the ducks when they're quacking and lay off your stock at much higher levels. And so if you continue to think about it as a private business, when this turns, it turns all at once, just like we saw with the small caps and the cyclicals and everything we've been talking about. And now currency starting to move. This is going to be even more abrupt. Why? Because the ball has been held down even longer. And for every action, there's an equal and opposite reaction. So we just like to see everything moving. Yen rally shakes up. Markets sending dollar to weakest since May. What is Xi mean? YG is pushing high quality development. We kind of covered that in the last chart. Traders betting on China easing. China leaders point to economic threats, but show no sign of changing tack. There was a key line in this I wanted to cover. Anyway, I covered the theme of it in what Brendan wrote anyway. Moving on to domestic stuff. People are asking, like, what is Trump going to mean? Well, during Trump's presidency, by the way, for all the bluster about tariffs, Alibaba went from $60 to $300 while Donald Trump was in office. So with all the China beatdowns and tariffs, it was actually a great environment for Alibaba, and I think the same is going to be true moving forward. Now, this is a key line from his interview with Bloomberg Businessweek. He says, quote, "I can't believe how many people are negative on tariffs that are actually smart. Man, it is good for negotiation." And that's the key in administration. Look, if I'm doing a good job, you shouldn't be able to figure out where I stand on politics, because there's nothing I'm really going to say about politics subjectively that's going to make you any money. So therefore, it adds no value. Objectively, I think we have a political tailwind coming for both domestic positions and for international. And the difference between the current administration and this administration, or potentially the new administration, is that the current administration has really been doing a lot of blaming and beatdown with no resolution in mind. It's really just making someone wrong. It's like it serves no useful purpose. The potential new administration is very transactional and does everything with an intent to get money, okay, and to get a better deal for the United States. So they'll threaten 60% tariffs on all imports in order to get a better deal from China. But once he sets the deal, it'll be Christmas again, because you'll have free trade, you'll have everything booming, because you'll know the rules of the game and you'll know the terms, and it'll be cemented, and it'll be a good deal for the U.S. Now, let's assume the worst case scenario. I saw a stat from the sell side yesterday. If Trump were to implement 60% tariffs on all Chinese imports, I thought it would put China into a Great Depression. The fact of the matter is it would reduce their GDP from plus 5% to plus 3%, which is still higher than the US, which was shocking to me. So the worst case scenario shows Chinese growth in the next administration higher than US growth. And the best case scenario probably accelerates their growth. And the expected scenario is probably going to be growth in line with 4.5% to 5.5%, which is fine as things start to recover in hockey stick and the big players get all the benefit like Alibaba. So what I would say, what I like about the prospects of a new administration from a China standpoint is it's not ideologically driven. It's pragmatically driven to get an advantage, to get a deal, to get something in return. It's like, yeah, we'll protect Taiwan, but pay us. We'll protect, XYZ, but pay us. I'm not saying that's right or wrong politically. I'm just thinking as a business person, that kind of makes sense. If you provide a service, you should get paid. And, I think it's going to result in another situation where, it's everything people think will do poorly will do probably very well in assuming that and it's way too early before November to tell. And the other way around, I wouldn't be shocked if green stuff does okay while Trump is in, as it did the last time. I wouldn't bet on it, but we'll see. We got that third plenum. Trump-Vance administration could herald a new era for the dollar. This is also China bullish, which is both candidates on the Republican ticket have argued the U.S. currency should be weaker to support American exports. When the U.S. dollar is weaker, emerging markets and China equities do better. China's biggest money manager says fears about growth in corporate earnings are excessive, and his base case for that is China's plan to increase per capita GDP to $30,000 US by 2035 from currently 12, implies massive growth. Look, I won't be there to see whether they hit 30,000 or not. I'll probably be out by the time they hit 16,000 in 3 to 5 years, but his point is taken and his point is correct in our view. We talked about Tom Lee on small caps. We talked about the NVIDIA $600 billion question. How value investors can benefit from a UK rebound. We already answered that. We own GXO. This was a huge deal this week. This is a busy week, guys. I didn't realize why I was... Okay. Luxottica bought Supreme for $1.5 billion. So as VF Corp owners, we got $500 more million than I expected, which means the balance sheet's leverage, which is why the stock's up some 30 some odd % in a few days, and just starting. Because now, look, VF Corp has been doing this since 1899. They've been trading in and out of brands, into growing brands, out of underperforming brands. They've been doing this since the beginning of the time. It's in their DNA, and now we're off to the races, and Bracken is rock and rolling. Very, very excited about that. It's another story just getting started. You couldn't give it away with a 10-put pole. And, if you buy at 15 and it goes to 12 before it goes to 50, who the hell cares? Picking bottoms is not... The key is I made my money by buying it at such a discount to intrinsic value. Did I know when the catalyst was going to hit? No, but I know that the catalyst will hit, and next will be the PAX business, and then next will be the indicators in Europe showing that Vans was starting to reaccelerate in Europe will start to spread all over the world over the next few quarters, and everyone will say, whoa, what happened? And Bracken Darrell will work his magic again, and the operating leverage embedded in it is phenomenal. Ford is making a comeback. It's time to buy the stock. I have a different way to play that. Disney's trying to be as addictive as Netflix, and I think they're starting to succeed. Ford stock is on an impressive run. The company is betting big on Ford Pro, so they can't keep up with the demand. They're switching EV factories to that super big truck. That's good for Cooper Standard. What a second Trump would mean for China. Goldman Sachs weighs in. We covered that. Ford pivots from EV plants to heavy-duty trucks at Canada facility. Back to the future. GM doing the same thing, increasing production of high-performance Cadillac Escalade V8 SUV. Welcome to the new regime. That's fine. Why Intel stock avoided the semiconductor sector's worst sell-off in 4 years. NVIDIA was down, AMD was down, Broadcom was down, Intel was up. What else can I say, ladies and gentlemen? Tomorrow's news today. So here's the biotech breaking out. Here's the small caps breaking out. Just the beginning. So you can see some of these indicators. McClellan summation, not really at extremes. So we'll see. We should get some end of July seasonal weakness, but I could also make the case for there could be some pushing even higher. So sea change activated stock market and sentiment results. In my last few public appearances since late June, I've been saying we're on the cusp of a sea change. Unmagnificent 493 would outperform Magnificent 7 in the second half of 2024. It's happening, ladies and gentlemen. As a matter of fact, it was so interesting. Fox actually quoted that headline when they put the video on their website. I think it's this Cavuto one. That was their subject. Hayes says cusp of a sea change, so you can pull it up here. But I said it literally in Charles Payne, in Liz Clayman, in Neil Cavuto, and in Varney and Company. So, and here we are, and you can see what's happening in the last few weeks. Bank of America up 15%, Crown Castle up 11%, Cooper Standard up 37%, Generac up 22%, GXO up 20%, Hormel up 9%, Intel up 20%, KRE Regional Banking ETF up 23%, Stanley Black & Decker up 16%, VF Corp up 27%, I think more today. XBI up 13.5%, that's the biotech ETF. Small caps 13.5%, and NVIDIA down 18%. So the red vertical line you see here on the NVIDIA chart is June 20th when we published our article, quote, the next pain trade, which we published before the market opened. And you can see what happened since. Do you think it's over just beginning? We covered the interview, which I explain it. Bank of America Fund Manager Survey, 4 key points. We put the summary here. You should look at all the charts. Number one, the most number of survey participants in 16 years believe monetary policy is too restrictive. In the last 4 peaks, in this level of too restrictive belief, marked at or near bottoms to buy cyclical small cap dividend pairs and international stocks. With the Fed funds rate greater than 200 bips above inflation, we concur with this point of view. 240 bips. Valuation of the U.S. dollar is 1.4 standard deviations above the long-term average. This will come down. Sentiment is mixed, not excessively euphoric yet. A little bit skeptical still. Least amount of people want to own real estate REITs since January 2009. That was a good time to buy REITs, so selectively. We own Crown Castle, which is not exactly real estate, but it is a REIT. It's towers, cell phone towers. 4 most crowded trades are long Magnificent 7, short yen, short China, short small caps. What's happening? Magnificent 7 is going down, yen is going up, China is trying to start to go up. It'll shoot up. Small caps are going up bigly. So all four are finally beginning to reverse. Now onto the shorter trend of the general market. Retail investors are euphoric, 52% bullish, 23% bearish. That's why you're seeing they're all crowded into Mag 7, and that's what's getting gut punched. We talked about the seasonality, late July. Just suck it up. It's going to be a couple of weeks. We'll see what happens. Fear and greed is neutral. So again, that shows you don't really want to move. You just know what you own. If it's still undervalued, if it's not excessive, if you got something that's excessively valued, like we trimmed Google and Amazon in recent weeks because we think we'll be able to buy it back lower. We want to own them long term, but we want it to not be pigs. Double pluses. You gotta ring the register every now and then. The other thing is I find myself using Perplexity AI a lot more than Google search, but we'll leave that aside. Okay. That's the fund manager survey. Earnings, financials up for 2024, 8 basis points, down for next year, 8 basis points. Healthcare earnings, again, also down 44 bips for this year, down 6 bips for next year. So maybe there'll be an earnings scare. We'll see what guidance looks like in earnings season. That's the name of the game. Economic data, I think we covered enough. And then estimates are coming down just a hair, 243.77 and 278.84 for next year. That's a little bit down from 279 and 244. So we got to keep an eye on earnings. With that said, the podcast is over for this week. We are going to move on to the Ask Me Anything question. For those of you who enjoy that section, we go through viewers' questions. We got an insane amount of questions this week. So stay for as little or as much of that as you like. And if you're tuning out, we'll see you next week. Thanks so much for tuning in. Please hit the like button, hit the subscribe button. If you're getting value from this, the best way you can pay us back if you're not a client already is to recommend it to one friend or family member you know who would benefit and who enjoys market. Reminder that, first off, congratulations to all the new clients that came in this year. We reopened to smaller accounts, $1 million plus, again, starting last Thursday, and that will remain open for the next week. We're grateful for the extreme demand this quarter. To see if you qualify and to take advantage of this opening, click here. That's just go to hedgefundtips.com and click on money management up here, and you can fill this out and see if that makes sense. So, all right, let's start from these. Zach Payne says, I have questions regarding the correlation between Alibaba and S&P 500. It seems to me when the S&P is falling, BABA follows, and then when it gains, BABA becomes uncorrelated. How strong is the correlation really in your opinion? I could care less. All I know is the free cash flow is solid and growing, and I own the business at an unbelievable valuation, and all of that is noise, and you're probably on leverage and should take down your leverage immediately. Ronan Bitten, I'm from Israel. Very grateful for the vast knowledge you share every week. Would appreciate your opinion on the following two stocks, 5 and Ball. Moving forward, guys, just do one stock. We're getting too many questions, and I can't do two. So 5 Below got shellacked. Dollar General, I got my eye on. These are all getting shellacked. I think this will probably bounce in the short term. I don't think I want to run into the burning building on this one yet. Let's take a look at the fundamentals on 5. I mean, the thesis here is, the free cash flow is rolling over. Let's see what it looks like on a quarterly basis. Yeah, negative free cash flow. Revenues are still going up. I think their issue, if I recall correctly, is comp store sales, margins going down. Over time, I think this one's going to be fine. I just think it's going to take quite a while to build a base. I would probably revisit this one in October, right before the election. See what it looks like. The revenues keep growing, but it's the comp store sales. They're adding unprofitable stores, basically, and that's the problem. So let's see if I can get this open here. It's not what I wanted to do. Okay, let's try it one more time. All right, that's a little better. Yeah, free cash flow is still positive. I think it's just a little early on this one. I wouldn't touch it yet. It's getting close. I mean, this is one I'm willing to miss. I mean, I'll keep an eye on this. If this hits a 6 handle, I'm going to start to take a look. But this has crushed a lot of people. So I think you'll get short-term technical bounces that are tradable, but I don't think I want to be a long-term owner yet. I'd probably be inclined to hit Dollar General before I do that. Ball Corp, since you're listening all the way from Israel, I'll do you a second one. I appreciate the support. Ball was an error of omission. I was looking at like a half a year ago, and I didn't do anything because we were fully invested. And it worked out fine. I think this is a great long-term business. I think you're going to be okay here, but not really where I get excited at these levels because my odds of a quick double have diminished when it's already doubled in the last few months. So yeah, cash flow is reaccelerating. Although revenues are down, I want to understand how that's going to reaccelerate. Let me take a look at quarterly, if that's accelerating or if it's seasonal. No, they're decelerating revenues. I don't like that. Declining gross margins. I don't like that. So this one, I would, if you revisited the 50s, I'd probably take another look at it up here with these fundamentals. It's not worth my time doing meaningful amounts of work right now, but long term, it's a good business. I just, price is what you pay, value what you get. I don't think the margin of safety is large enough for me right now. Jack Greenberg, big fan. Thank you for all your hard work. A few weeks ago, you mentioned you were going to look at QXO due to being a huge admirer of Brad Jacobs. Have you looked at said stock? It's gotten crushed lately. Can you explain the recent volatility? No, I'm not ready yet. I saw what's happening. Not doing anything yet. Happy with GXO. Brandon Walters, been a long-time listener. Wanted to thank you for wonderful content you're providing us. Been holding Alibaba, just sitting there without doing anything while the S&P moves higher. When would you say, is it smart to just throw in the towel and say there are better uses for my money, or should I just hold it regardless of what happens to the stock as long as the fundamentals are good? Hold. Okay, so I don't know what you should do. I know my framework is identical for every company that I take an ownership stake in. And some double overnight and some take 4 years, but the mean is, I get the expected outcome in 36 months, and I can't control the timing. I can only control the analysis. And I've never been in a position where I got more value per dollar than Alibaba and had more potential upside with limited downside than Alibaba, because the liquidation is much higher than $80 a share or wherever it's trading today. So as far as you go, and I'm not being flippant, if you want to chase shiny objects for the short-term high, go for it. But in the long term, I'm going to crush you like every single time, because out of my basket of 8 to 12, using that same intellectual framework and thinking like a business owner versus a gambler, I'm going to destroy it because I'm buying great quality businesses at abnormal prices that would never be entertained in the private markets. And in aggregate, they're all going to be figured out in 36 months, with some doing way faster than I expect and some doing a little longer than I expect. But 2 years is nothing in the scheme of what I'm looking at for these businesses. I look for multi-baggers over 3-4 years, and sometimes it takes 5, and sometimes I want to hold them forever. So for me, nothing's changed. And if the market had been closed for the last 2 years, 5 years, or 10 years, and I looked at the business performance, I would say I'm getting seriously rich. And now I just have to wait for price to catch up. I made money on Alibaba the day that I bought it at the discounted price. And when I got lucky opportunities to add in the 60s and in the 70s, I do it all day long because I know what I'm getting and I know what I'm paying, and nothing will change. And then, when it hits 200 and 250, everyone will be like, oh, you're such a hero. But in my mind, it is always that. It never wasn't that price. It's just that they gave me the opportunity to buy it at a 70% discount to what I believed intrinsic value was. So I took every single advantage within the realm of risk parameters, not exceeding specific weights, and being humble enough to accept that there, in any position, there can always be something that you don't know, that you can't possibly know. But that's a super duper low probability and not the case here in our view. And so we're excited and we'll continue to take advantage of it. As for you, you should do what you believe is in your interest, but I'm doing what I know is in our interest. Will Porter says, Tom, I've been a financial advisor for 25 years and work for a very large firm. I truly believe I've learned more listening and reading your generous research in the last year than my entire time in this business, so thank you. Will, that is a very generous thing for you to say, and I'm very grateful for you to say that. And I'm glad that I'm providing value. My question is about small caps. This move has been tremendous, but 95% of pundits think it will not last because of their lack of earnings growth. What, their lack of earnings growth tomorrow? We just told you what earnings growth is going to be over the next 7 quarters. So I think I answered your question earlier. Could you please give me your thoughts on why this could be a multi-year move higher? Thanks for all the incredible content. Well, we just covered the mid-cycle 95. We just covered the 2001. We just covered all the conditions precedent to sustain this rally, and everything's in place. So could something else happen? Yes, but I would bet with the odds, and the odds are this is going to sustain for some time with fits and starts. And we've got to shake out. Look, all the schmucks bought it yesterday after it had like 11 straight days up, so they're going to get smoked. And then we'll bring them back down to reality, knock all those leveraged idiots out, and then we'll take our sustained move when everyone says, oh, it's going to be another fake out. They'll be saying it's going to be another fake out for the next six months and 40% upside. So let them enjoy their emotions, and we'll enjoy our profits. Paul Falcone, I feel like we just had this conversation 6 months ago about Dollar General. But Five Below reported their guidance missed estimates, has been selling off like crazy. Valuations are extreme lows, and they still plan to almost double their store count over the next 5 years. Question is, are same-store sales profitable? Answer is no. So sales will continue to increase, but it's comp store sales, and I'd just be a little skeptical. Let it pound out a little bit more, and for me, it's not time yet. It'll be time. I'll probably revisit that one in October if we get a little market sell-off, but it's not the right time right now. All right. Nick Saltarelli, my man over there at middaysquares.com. He runs this chocolate business. You can get their delicious chocolates in Costco or on their website. He sends me some time to time. I love their newest flavor. Check it out. So Nick says, Tom, please stand up on the VideoCast and take a bow. You called everything to the T. Rotation happening and VF Corp selling supreme and immediately rocketing. Thank you for all you do for us. Okay, so I've watched enough Japanese samurai movies to know the minute you take a bow, they slice your neck off. So I'm not going to take any bow. I do appreciate the acknowledgement because I work hard to deliver value for everyone. And I'm very grateful for that. But wait till China kicks in on top of it. Then I'll say this, I'm not taking any bow despite that things are rocking and rolling right now. I will take a bow when I meet my goal of 30 to 40 million in aggregate profits for my clients this year, and but more importantly, two, when Alibaba gets over $200, I'll start to take a bow, and when it gets to closer to our estimate of intrinsic value, I will stand up and bow. But prior to that, stay humble, man. Just work hard, grind, and stay humble. Glad you're enjoying it. We're happy to. And it's just beginning. So grateful for that consistent, nonstop, everyday support. And that same relentlessness is what's driving you to success with your chocolate business. And keep at it, my man. Dave Hill. Hi, Tom. Love your show. Been following a couple years now, and you always deliver excellent insight. It's my favorite investment. YouTube watch or podcast listening on the runs right now. Hey, if all goes well in my business over the next couple of years, hopefully I'll be calling you with a chunk of money to manage your investments. I'll be here and grateful to be helpful at that point in time. Thank you for your support. Now on to the ask. Whoa, okay, a little foreplay before. Okay, I get it. What do you think of Trincio PLC? Was flagged to me by a friend. I've been watching it for about 3 months now. Haven't bought it yet. Digging around. Love to hear your thoughts, Dave. Trincio. Okay. TRINSEO. Okay, negative free cash flow reflected in price. Not an ideal situation. Revenue's choppy. This is not my ideal. I'm guessing this is like a minor or minor related thing. Yeah, this looks like it's probably going bankrupt. Let's just see what their balance sheet looks like and what they do. Specialty Materials Solutions Provider. Latex Plastic Solutions. Blah, blah, blah. Let's take a look at the balance sheet. So I got 166 million of cash. And they have 2.2 billion of debt. Huh. And they've got negative 26 million of free cash flow in the last 12 months. Let's see quarterly if there's any trend here. Last 3 quarters have been negative free cash flow. I'm not loving it, especially when they've got Yeah, not loving it. Let's look at the annual here. Yeah, I'd pass. I mean, if you can listen to the last 8 calls and understand how they intend to turn it around, let's just see. I mean, I don't really care about words. Let's see what their revenues are doing. Yeah, they're trying to turn the corner. Wait, let me just see here. Nah, I don't think so. Let's see. I just got to know how the revenues are going to reaccelerate, because if they're not, they're going bankrupt. So I'd want to understand the plan. I'd want to understand the cyclicality of the business. I don't really know this business well. Plastics, latex binders, polystyrene, resins. Let me just see here. I mean, look, it looks like it could be a rocket ship. I mean, maybe I'll jump on a few conference calls, but I don't think this one's going to find its way into the portfolio. But I can definitely see it possibly working. All right. Thanks for answering my question last week. This is from Tim Felmingham. Another great week, right on the money analysis and information. Your approach is certainly working for me. Question. Let's say you have a basket of 20 chosen stocks through your approach. How do you allocate capital between them? Do you start out on equal weight? Do you rank them in some way? How and when do you rebalance them? Thanks again. Tim in the UK. That's proprietary to clients, and it's going to depend on expected value relative to risk probability weightings to achieve that expected value, and we size accordingly. So some may only have 2 or 3x upside, but our downside is pretty much cemented in, and the business has an unpenetrable moat, so we can put huge size into. And others may have an expected value of 10x, but they're on a razor's edge, so we might only put 3 or 5% to a position like that. So we do balance that accordingly, and in the context of a portfolio, and that's just 20 years of experience, and some of that has to stay proprietary for the benefit of my clients. Peyton Hops, Nike has been beating the past 24 months. Taking a beating in the last 24 months. It's approaching new relative lows. Would this fall in your watch list? If no, when? When does it qualify for turnaround? Tom, endorsement. Yeah, I'm watching it. I'm doing nothing. This one's probably almost guaranteed to be an error of omission. And the reason I'm not doing anything is because a lot of the turnaround is going to be dependent upon China, even though it's interesting, as much as everyone's been pounding China because Richemont and Burberry, have had bad sales in China, but Goose has had great sales, and Nike had sales down in all regions except China was basically their only positive region, up 2%. So this is kind of a China story, and I feel like I have enough exposure to China with Baba, so I haven't really leaned into this or Lulu or Starbucks. I think all 3 of them are on the quote-unquote watch list, and I'm not eager to move immediately, but I'll keep my eye on it. Leave it at that. John Savin, really appreciate all you're doing for your audience. Love the content. Want to ask you how you always manage to find new investments, or was there a time since you're running hedge fund, you had new investors coming in and you thinking to yourself, everything is expensive now, let me sit on my hands? Really just curious to see whether you always need to find undervalued companies, or if you're fine just waiting for a better time in the cycle. So we run separately managed accounts for clients. And the reason we do that is because oftentimes a lot of money comes in after, some of our public positions have made huge moves, or the market's made a general huge move that we called. And what we want to avoid, which you can't avoid if you're in a commingled fund, is that all the new money is buying those stocks that are already up 75, 100%, 150%. that you want to hold, but you think might be due for a rest for existing clients, and you don't want to sell because you know they're going higher, but you don't want to pay taxes, but you don't want to put new money in, and you want to be able to put new money in those companies that you believe are just leaving the station versus already flying at 30,000 feet. And that's what the separately managed account format enables us to do. So at every point in time, we can put new clients in those companies that are just starting to take off versus the ones that have already ripped higher, which gives us and our clients an advantage when they come in. So we don't have problem. I mean, even right now with the massive rally that we've seen in a lot, that I can tell you right now, and I have a lot of new money coming in. I know exactly where that's going right now, and I have absolute zero concern because of where we're able to buy, and the money's made when you buy, and then we'll just wait for a price to be realized. So no, there's plenty of stuff to do today, unquestionably, but they're not the same things that there were to do 6 months ago because a lot of those things are way up now. So that's how we've set up to deal with that exact issue. And in the context of the 2001 cycle that we've been talking about, and the 80-82 cycle and the 2009 cycle and where we are in that, it's early days, but we got to get cracking. Like, we don't want to, it's going to be harder. It's going to be much harder to find these opportunities 6 months and a year from now as it is right now. I mean, there's just no two ways about it. We'll find other opportunities because there's always sector rotation under the surface. But right now, it's literally like fishing with a shotgun. I mean, it's unbelievable. So Kevin Figelmuller with 2 dots above the U. So that must be someone foreign. Hi, Tom. Thanks for the great content every week. Was wondering about the China data came out and the economy grew by 4.7% year on year. How come the Hang Seng and Alibaba are down? The stock market is not the economy in the short term. It's a voting machine based on emotion. Expectations were 5. It came in lower than expectations, higher than the rest of the world. And it is what it is. Everything's hated in China until it's not. And then everyone will be chasing all at once, just like you're seeing with small caps. Remember what I say, and you're seeing it now. When it happens all at once. The longer they stretch the rubber band, the harder it snaps back when it comes back. Luke Munchin, thanks for the great content. Just wanted to ask what you would say would be better for Alibaba position, Trump or Biden administration, and why. I think Trump, just because of what I said earlier for China, and under Biden, Baba's done poorly, and under Trump, Baba was a 5-bagger. So there's the answer. And he was rattling, back then, by the way, he had that guy, I mean, not to get political, but that guy with the gray hair that went to jail. Anyway, my mama taught me if I don't have something nice to say, don't say it. But I don't think that guy's going to be part of the administration, and that's a good thing. So, all right. Ite Naman, been seeing the Aston Martin brand repeat a lot during the years in the articles of the day. Looked at the company and it was a mess for many years, but started looking interesting recently. I don't want to buy a car manufacturer. Leave it at that. Jeff, I mean, you could say, oh, you missed Ferrari. Okay, so what? Error of omission versus commission. All right, I'll take a quick look at it since you spent the time to write the question. I don't put it in the article of the week because I like the company. I put it in the article of the week because on the weekend I like to put some fun stuff in the articles of the week because I know that you guys have been working hard all week and want to have a little fun. So, yeah, all right. So, let's see. I would not. All right, Aston Martin. Yeah, this is kind of odd. I wouldn't have expected this. I still don't want to buy a car manufacturer, but let me just see. Well, they do have that sick SUV my friend got. And some of their coupes are really nice. They're touring cars. Free cash flow is still pretty darn choppy. What's their balance sheet look like? $5 billion of debt, 500 million. Yeah, I know what you're looking at here. Might work for a trade for a quick double. I don't like it, but I like that you found it. I just don't like it. Not there are just there are instincts you get from doing this for a long time, and you know what things to just avoid. But I definitely see that a trade could work here, but I'm not going to participate. Jeff Hrivnak says, what are your thoughts on Nelson Peltz's shareholder activism and not getting a board seat? In general, is shareholder activism good for a company from a perspective of shareholder? Yeah, it is. Not getting a board seat, I could care less. I mean, Starboard Value is good. Nelson Peltz is good. The key is sunlight is the greatest disinfectant, and they all raise what could be done to unlock the value, and that tends to be a good thing for shareholders. So, because it puts pressure on management and the board to take action versus just collect their checks. Jason Z, taking my DJ hat off this week, wanting to get your thoughts on Honest Company, founded by Jessica Alba, now run by a credible CEO with Amazon and General Mills experience, sells consumer goods, known for eco-friendly diapers and beauty products. 2 quarters, turned from a net loss, net positive. Less chemicals in diapers, wipes, and shampoos. Take share from P&G. Let's see. Okay. Gross margins are collapsing. Free cash flow positive. Consistent destroyer of capital. Revenues are trying to grow. Yeah, it's trying to recover. I don't know. They're going to need a growth story, though. I mean, let me see the multiples here. Nah, not for me. I don't think they're going to be around. I mean, if you're lucky, they'll get bought out by P&G in 2 years if they do turn it around. But I don't really like that stuff. Bob Johnson, very interesting one for you this week. Zoom. Yeah, we covered this one a few weeks back. I mean, the financials look good. I think it's more like Peloton. It's an annuity now. It's like you're not really going to get a lot more growth from it. This one should be bought out by private equity and just milk the cash flow, lever it up. There's just too much competition. I mean, if they raise the prices, people are just going to go to another platform. They're all the same. I mean, I noticed no difference between Zoom and Teams, and I mean, I probably like Zoom the best, but let's see. All right, financial analysis. Yeah, revenues are kind of steady state, moving up a hair. Balance sheet's probably great. Yeah, looks like $6 billion in cash. They could buy in a lot of stock. Free cash flow. Free cash flow is great. Multiples. Gross margins. Gross margins are surprisingly holding in. Yeah, I see what you see here. I just don't know how, I don't know what their durable mode is. So I'd have to really understand the business to just figure out why people are going to give them $4 billion a year of real money when they could get a comparable service from Google for free or from Teams that's already in their bundle. But there must be some reason people are doing it, or they wouldn't keep having this. So I just want to know how they're going to protect the moat. So that's the analysis you have to do, and you really have to understand it. But financially, it looks great. But why is it going to stay that way? And is there any possibility to reaccelerate growth? And I don't have a good answer to that, but I doubt they're going to exceed what they got in COVID. Jimmy Jones took your advice, looked at your videos, major buybacks, AI plays. Does this affect? What do you see? What are possibilities? No, none of our view on that has changed. We think fair values, 280 to 320, and maybe a lot more if we get some AI boost. But in the 200s, we'll lay some off. If we get a 3 handle, we'll lay a lot off, and probably hold a trailer for some of the dreams, because by then everyone will be super bullish on AI or whatever the new story is. But it's just a leveraged way to play BABA with limited downside. Limited way to play China with limited downside and possibly meaningful multi-bagger upside. And we like it. So Continental AG, German auto supplier. Okay. Continental AG. Guess this is it. Just make sure. Solutions for vehicles, automotive. Okay, so this is it. So yeah, it's another Cooper standard plate. I got enough Cooper standard plays. Revenues trying to recover. Cash flow looks solid. Balance sheet looks good. Return on capital declining. Gross margin declining. I mean, the real risk you have with anything related to German automakers is they've been flooded with Chinese cars. So so you just got to get comfort around that. For me, I probably wouldn't take the risk on anything German auto related, but at a cursory look, if I wanted European exposure, I would be willing to dig in on this one. I think at initial blush, it looks okay. But you gotta now the work begins. Now you do 3-4 weeks of research, channel checks, competition, conference calls, look at the investor deck, et cetera, et cetera. So nice find, by the way. Kyle Meacham. Hey, Tom, legendary podcast. Just found it 3 weeks ago, and I've gobbled up every single episode backwards through April already. Can't get enough. Learning a ton and appreciate you. Wanted to ask your opinion on Prospect Capital. Okay, so they've got a high yield. It's 13% a year. It's not 13% monthly, by the way. They're not real estate. I think they have natural gas properties, if I remember correctly. And a friend of mine met with the owner years ago during the great financial crisis, was very impressed with him, made money with it. I think it's okay. What I find with this guy, if I'm not mistaken, is the time to buy his stock is when he's buying it. And I think he's been buying it. It's basically like a three-man show. It's like him, his wife, and like one admin running, a multi-billion-dollar public REIT. And he's a big buyer of his own stock when it's mispriced. So let's see what he's been doing lately. John Barry, yeah, that was his name. So in May, he bought $4 million worth at $550, and it's at $559 now. They do middle market, mezz finance, leverage buyout, yeah, I thought there was an energy tilt to this, though. Best in defense, chemicals, conglomerate, coal, oil and gas production, I remember that. Utilities, pipeline storage. Yeah, I mean, this guy's a solid operator. So, I think you've probably found a decent one, but do some work before you invest and, talk with your financial advisor and everything else. I'd have to, do probably 2-3 weeks of work before I would invest $1 in it. But I think you're on the right track, and congratulations and welcome. So with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.